My two panelists to my left is Dr. Poonam Gupta. Poonam is the Director General of the NCAER, very well published economist, macroeconomics as her field of specialization, and currently also on the Prime Minister's Economic Advisory Council. To my right, Dr. Viral Acharya. Viral is a professor at NYU, and he also served as the Deputy Governor of the Reserve Bank of India in the years 2017 to
19, yeah.
18. Okay. So what I want to do is very quickly take 5 minutes to give you a little historical perspective on India, bring you up to date, and then we would actually have a more detailed discussion of a number of issues. A lot of this has already come up, but some salient features or some salient facts actually have still not been spelled out. One of which is that, it is little recognized, but the fact is that from 2003-4 to 2019-20, India has grown on a sustained basis. This is a 17-year period. It has grown at a sustained rate of 7.4% annually. So during this period, in fact, India's GDP has probably certainly tripled, but may have quadrupled. In dollar terms, it certainly is close to have quadrupled in real terms, actually. So this has been a very, very important period of transformation for India. And this sort of, comes on the back of almost 50 years of relatively slow growth. And it is this transformation with which we now take as sort of the baseline, and that is where the conversation begins. Now, we had, of course, 2 years of interlude during the COVID. So first year of COVID, the GDP actually fell by 6.6%. India did recover pretty fast. So the following year, the growth rate was, which is the last fiscal year, 21-22, was 8.7%. But then also the Ukraine-Russia war came along, and that gave another kind of shock to the economy. And against that backdrop now, also with inflation, high inflation in the United States and consequent action on the interest rates, which has led to the flow of investments from out of India into the United States, movement of a lot of the more fluid capital that can easily move, particularly the financial capital, but also investments in the portfolio equity, which can move fast, relatively fast, has been happening, and so there's brought some pressure on the on the rupee value, and that is the kind of background against which then, though regionally IMF and the World Bank were forecasting growth rates for the year 22-23, 8% or more, now have kind of scaled it back. IMF has gone to, I think, 7.2%, World Bank at 7%, something of that order. Even the Reserve Bank of India, which was forecasting 7.2%, has scaled it back to 7%. So where we are going to start, since Poonam is the one with the greater specialization on macro, but we'll have Viral's view as well. But I will start with you, Poonam. So first of all, I just want to get a sense of your view on where do you see India's growth heading, just in this year first, and then we'll come to the bit of more medium to longer term, and speak in the context of how you see the rupee performing, inflation, but really ultimately, what is your view on how the GDP would do this particular year, the fiscal year 22-23?
Sure. Thank you very much, Professor Panagariya, and thanks for having me over. As we all know, economists are not a trusted lot these days, and macroeconomists are the worst. And the two reasons for it, one is that it's easy to fake to be a macroeconomist. Everybody has a view on the economy, growth, inflation, everything. And I encounter them a lot. The other thing is that we have to understand that forecasters and macroeconomists are two different things. I'm not a forecaster, but I'll take a view on where I think the growth and everything else that Professor Panagariya mentioned is heading. So I think a lot on the economy has been said this morning when we had a fabulous panel with 3 secretaries. Very upbeat assessment of how the Indian economy is doing. And Professor Panagariya has given the context as well. But let me just paraphrase it a little bit. If it were not for, actually not just the Russia-Ukraine war, but the US inflation, which is a big problem through its monetary policy for emerging markets such as India, India would have certainly grown at 8% this year. And we can go into the reasons for why it would have happened. But 2 big shocks as far as emerging markets such as India are concerned have happened this year. US inflation running at 8% is not US problem only. It becomes India's problem because the way the interest rates are being hiked up by the US, it means that first, the cost of borrowing increases all around. And second, a whole lot of capital reverses from India, and which has its own issues. Second is the global growth outlook that is being put out and global trade outlook. Whether we like it or not, India's trade co-moves very closely with the global demand for trade. The elasticity is close to 1. So if global demand for growth or global growth slows down, India's trade slows down. And that's going to have an impact on India as well. And it can easily take off 1 percentage point off from growth. So instead of 8%, India may grow at 7% this year because of the impact of the global slowdown in exports. Having said that, these days everybody wants quick assessments and quick analysis, which means that some of us end up looking at what are called high-frequency indicators of the economy. And there are about 25 such independent indicators. And you look at them. Most of the indicators are showing resilience. So if we look at those indicators, nearly 20 of them are showing positive growth for India, good growth for India. The handful of indicators which are not showing such promise, and I've already mentioned one of them, exports of goods, did very well for the first few months of this fiscal year, but have started to slow down. The other is, of course, capital flow reversal. So overall, my assessment is India would have grown at 8%, except that these global shocks, well, these are not global, US. The shock originated in the US and in Europe are going to impact India. And now let me also take a view of inflation and exchange rate that was posed to me. These days news are very sensational, and I think that makes them sell better. So we keep hearing about that inflation is going through the roof, etc. in India. But somewhat careful analysis shows that this year India's inflation so far during the fiscal year, which started on April 1, has averaged to 7.2% as compared to 5.5% last year. So that's an acceleration of 1.7 percentage point. You break it down and you see that majority of this inflation, actually nearly 1 percentage point, is coming from vegetable prices. Now, it has 2 implications. One, it's transient, right? Vegetable prices ultimately will cool down. It's not imported inflation, it's domestic demand and supply mismatches. So it's not, this inflation is not going to stick around. It will come down in, let's say, a couple of months. Second is the role of monetary policy, but that's another matter. I will not take it here. But in another forum, I said that vegetable prices are holding India's monetary policy hostage. So I think we need to understand where this inflation is coming from. On exchange rate, which has depreciated by nearly 10% this year, is a direct fallout of, again, the global developments and how they have impacted India. And 10% is more or less in line with what other large emerging markets have experienced. In fact, some of them have experienced a slightly larger depreciation. And those which are commodity exporting countries, such as Brazil, haven't had a depreciation of this order. Some of them have had a neutral exchange rate impact. So overall, exchange rate is a part of the solution under the current circumstances. So when your capital flow is reversing in the short run, one of the best policy tools is to let exchange rate take its own course. You can fight against this depreciation for a limited period. You can try to modulate the pace of depreciation, which has happened already, but eventually this depreciation is inevitable. Some of it is what is called overshooting. There'll be overreaction from the market. And just put in context what happened in 2013 and 2018, when there were similar reversals of capital flows from India, exchange rate had depreciated by about 22% each time. But it was a short-term phenomenon, and eventually it corrected itself. So we may see something of like that happening. I think about 10 to 11% of depreciation has happened already. If US is not able to tame its inflation, and especially if the dot plot of how the monetary policy is going to be shifts rightward, then we may see some more reaction. But I think it's a part of the game. It's a part of adjusting to the kind of shocks I mentioned. I'll stop here. Thank you.
So I'm going to return in a minute to you on the export performance, but first, Viral.
Thank you, Arvind, and thank you, Deepak, for arranging this conference and inviting me. I just want to add a couple of points to just ponder over on inflation and the exchange rate, and then maybe if there's time, I'll just mention a little bit on growth. I take a very common man or a common person's view on inflation. Sometimes in macroeconomics, it's easy to just focus on the overall growth rate of the economy, etc. But I think the reason why India has agreed on a 4% target for the consumer price inflation for its monetary policy committee, presumably is because a sustainably higher rate than that is hard to generate without sort of eroding actually the purchasing power of the common man in India. So I think inflation has been above 6% actually on a sustained basis now, I would say since pre-COVID days. Maybe there's a shift in the central bank's thinking on this front. But my sense is the common man's wages are not keeping pace with that inflation. I think urban India, the business newspapers, which of course I also read, convey a very different sense about this inflation, I think, than what the common man in India is experiencing. And I think that consumption engine, which is in the where the propensity to consume is very high. If you give a wealth transfer to the poor person, actually the consumption picks up the most because they are the ones who are most constrained. I'm a bit worried that if we continue to think that 6-7% is the norm of inflation that we need to maintain going forward, we would be entering 5, 6, 7 years of such inflation in no time. And I don't see how simply the rich consuming more and more and more can be the story of India's growth. So I would I just want to throw in a word of caution on thinking that 6-7% is a norm that we can comfortably live with. And I think this has implications for the exchange rate. I think ultimately India's exchange rate and the stability of flows will be contingent on whether the money that has come into India sees that it won't lose its value in a real term sense. My sense is the Fed will do whatever it takes to bring the inflation down. I think this level of inflation in the United States, both at core and the overall headline level, is politically, I think, not feasible to have for too long. I think there are now repeated references to what Paul Walker had to engineer in the United States, which was a recession in the 80s. And unless there is some huge financial accident along the way, I see the path of US inflation over the next year as coming down very, very sharply. Housing markets in the United States are already down in a correlated manner across pretty much all the big geographies, and it's because the mortgage rate pass-through is very, very high. What that means is that if the inflation differential between India and the US in anticipation over the next 1 or 2 years grows once again, where India keeps inflation at 6, 7, 8%, and US is actually moving back towards its norm, I think it will only result in further foreign capital outflows, in my view. So I'm actually firmly in favor of India doing what is the legal mandate of the central bank, which is to target inflation at a level of 4% within a band of 2 to 6%, rather than being at or above the band, which is actually above 6%. Just one last point on the growth. I'm here with both Arvind and Poonam. I think there are a lot of sort of budding shoots of growth in India. I can touch a little bit on what I think are the most promising ones there. The only wrinkle I would throw in is that I worry a little bit about wealth and income inequality that I see in India. I see it in Mumbai every time I go there. I see it in what's happening to my friends versus what's happening to my neighbors. And I think that gives me a bit of a pause. As again, I want to repeat, if just urban India, if just the rich parts of urban India keep consuming and growing well, I don't think that can lead to a very stable growth for India in the long run. So I think we have to worry about inflation. I think we have to worry about the distribution of growth in different segments of Indian society. And I think we need a greater balance in those outcomes, in my view.
Let me push you a little harder. I mean, if you look at the past history, recent past history, with 5 to 6% inflation, India has grown very well. It has also brought down poverty, at least for the period from 2004-5 to 11-12. We have very hard evidence on poverty reduction. It is across the board. I mean, you name any group, I have done the numbers, whether you look at the rural areas, you look urban areas, you look at the scheduled caste, scheduled tribes, Hindus, Muslims, because all these sample surveys allow you to capture all this. Every single group you see significant decline in poverty, probably a little bit less among the tribals, but even there's significant one, especially 4-5 to 11-12. So why is it that you take such a pessimistic view that even that we have to have 4% growth, 4% inflation, without which we can't really grow without the poor getting badly hurt?
Yeah, I'll maybe stick my answer to 2 points. My first point is almost like a matter of technocratic principle, which is that there's a legal act, which is the Monetary Policy Act. It charges the central bank and the technocrats who run it to achieve a target of 4% consumer price inflation. I don't think technocrats should get into the business of interpreting law and the acts the way they want. I've been a central banker myself, and I would feel grossly uncomfortable not being an elected official of the people of the country to interpret that the law says 4%, but my interpretation of this is 6%. So I just have sort of a very technical issue with the entire dialogue around the inflation in India having shifted away from what the legal mandate of the central bank is. If you don't like the law, my recommendation would be change the law. I think you can change the law to 6% being the target inflation. I think it's entirely possible. But I think I'll come back to the point on equity. I think my point is more about the last 3 years. I think the stimulus measures that were adopted in India post-COVID, I would say it was very heavily loaded on monetary policy side, less on the fiscal side. And what that has created is that essentially the inflation has deflated the debt of the large Indian corporations. But as you know, COVID was a very large shock to the informal sector of the economy. My sense is that on-ground informal sector in India has actually suffered quite heavily in the last 3 years. As I was saying, my interactions with people around me in Mumbai seem to suggest that their wage growth, their income growth is not keeping pace with the level of inflation in the country.
Okay, I'll just add 2 points here, and then I come to Poonam. First, of course, even if you want to be technocratic, right, the mandate is 2 to 6. So technically, I think the RBI is quite well within its rights to have the inflation between 2 and 6. There's nothing that says that you have to keep it below 4. On what happened during COVID years and all, at least the evidence, there is one piece of evidence that comes from the periodic labor force survey, which I trust, in fact, more than any other survey that we are currently having. That certainly, there is one question which actually asks on expenditure. It doesn't ask for the details, but what was your expenditure? I have checked those numbers. Actually, they in fact do not show any decline in poverty, any rise in poverty. Actually, whether you look rural areas, urban areas, poverty during this period also continues to decline. But that's work in progress. I don't know to claim too much for it, so I'll keep that up. Poonam,
let me just first take the inflation question.
That also, but let me also.
Yeah, I just want to make one technical point, which is that I think, I was in charge of the Monetary Policy Committee at the Reserve Bank of India, so I've read the Act very, very much in detail. The central bank's mandate is to target the inflation at 4%.
What is plus minus 2?
Plus minus 2% is basically allowing for any kind of noises that allow it. I think over the last 3 years, central bank has maintained the average inflation at over 6% for 3 years in a row. It's not at 4%. The target is 4%. 2 to 6% is the band in which no central bank can do marksmanship precisely at your target. I think when the target is being deviated 3 years successively in a row, in my view, it's a sign that we are shifting away from the target being 4% to 6%.
Yeah. Before you come to you also, one question. Now, you said about the export performance. It strikes me, last year, I think the export performance was incredibly good. And we certainly didn't, our exports grew way faster than the growth of the global exports. And particularly if India allows the exchange rate to depreciate a little bit more, at least my reading would be, I would assert that export performance could actually be a lot better than the global export performance, which means that we can actually increase the share. India's share is still only in merchandise exports 1.7%, even in services it's below 3%. A country like India, which is heading towards 7, 8, whatever percent of growth, ought to actually do that kind of export performance, and with some support from the exchange rate, perhaps it is feasible. So that plus anything.
Yeah, sure. Inflation is more exciting to respond to. When I came here for this panel, I thought it will be a boring vanilla panel because we all are on the same page, and I'm glad it's not. I have defended inflation targeting framework publicly. Viral knows that. I recently wrote an op-ed, which actually many people, including Swami, perhaps didn't like, in defense of inflation targeting. And what I was defending exactly was the range, not 4%. So if we talk about the trade-off between inflation and growth for India, whichever work actually done at the RBI earlier used to show that level to be 5 or 5.5%. So my interpretation of the inflation targeting framework, and you don't have to be a central bank governor or deputy governor to read the law, anybody can read the law as I have done, was that 4% central parity was kept at a time when inflation was running into double digit. So it was a way to bring credibility to the monetary policy framework, but enough flexibility was kept for it to be interpreted between 2 to 6%. And when COVID happened, it was certainly an unusual circumstance. And when global inflation is running at very high levels, then this is exactly the time to interpret it to be 4 to 6%. If not now, then when? There are a couple of things that Viral said and in the manner he said, which I find quite intriguing. So when he's discussing the US inflation target is 2% and it's running at 8.5%. Viral seems, sorry Viral, I don't want to be personal, but it's more interesting to say it like this. When Viral says that US will be able to bring down its inflation from 8.5% to a lower level, first, what is that low level? What I'm reading all around me is that it's possible that US may bring it down to 4% and just let it go at that level. So twice the rate of its inflation targeting framework. For India, we want to bring it down to 4%, the same level that the US has, does not make sense at all. Second is that he's attributing the prevailing rate of inflation of about 7%, most of which 1 percentage point I'm attributing to vegetable prices, as if the monetary policy is lagging. Monetary policy has been as reactive to domestic inflation rate as the US policy has been to the US inflation rate. So I think I see some disparity in how the monetary policy action is being interpreted. So yes, there is enough flexibility to interpret it 4 to 6%. This is not the time to change it to anything else formally because of the way the flexibility has already been given. If these were normal circumstances, perhaps as an economist, I would have recommended that it's time to now take it to a narrower band. But given the kind of exceptional circumstances we are in, 2 to 6% is great with the flexibility it affords us. Monetary policy is doing what it can. Ultimately, 45% of the inflation basket is food, and a significant percentage is vegetables. So the discussion that can happen is whether the basket is representative of India's average consumption basket or not. Should we reduce the price of weight of food? And vegetable prices cannot be modulated by monetary policy, and better supply and demand management is what is needed. On trade, Professor Panagariya, so the way I looked at the data was, as I said, high-frequency data, looking at monthly exports numbers of merchandise for the last 1 year. And you're absolutely right that Indian exports did much better than the global exports for almost all of this 1 year. And so its share in global trade had started to inch up. It's a very small share, we know that, right? So India exports only 1.6% of the global merchandise trade. And that share inched up in the monthly and quarterly data to 1.7 and 1.8. But at the same time, it may still be growing a little faster than the global trade. In the last 2 or 3 months, it has started to come down, the growth rate. And that's the worry. And that worry stems from my analysis of the economic slowdown that India had experienced during 2019-20, when growth had slumped down to 3.7%. And that analysis has stayed with me. A good 1.5 percentage point of that slowdown was attributed to slowdown in merchandise trade. So that analysis has just stayed with me, and I want to be a little cautious that in a global market, which is going to be more or less stagnant on goods exports, India may not be able to beat the market by a whole lot. So 7%, with this shock, and if you are if you are more accurate than me, then of course we can get that extra kick from exports as well. Thank you.
Do you want to say something, or we can
no? I think we should move on.
Okay, so thank you. We'll leave this subject of the very short run, this particular year, current year. Next, I want to move on to the medium to long-term growth prospects. Now, at least some basic reading of the data seems to suggest that there has been, during the COVID years, a lot of structural adjustment. A lot of bankruptcies did happen. IBC through the IBC, many of the very large cases that had been kind of pending, that while you were the deputy governor, had been pushed through by you and Urjit. they've been largely cleared. In many cases, the management has passed on to the other new buyers and so forth. So it looks, and by all accounts, it seems that the balance sheets of both the corporations, non-financial corporations, as well as the banks, etc., are now in much healthier position, which seems to suggest that, at least, there is some evidence going from Korea post 1998 crisis, when a lot of the big structural adjustment happened in Korea, and finally Korea, got out of this middle income trap and began to grow faster, much faster. Something similar seems to have happened in India in the last 2 or 3 years, which kind of, at least personally, I feel more optimistic. So are we returning to the robust 7 to 8% growth in medium to long run? So start with you.
I'll make maybe 2 observations there. I fully agree. I think the Insolvency and Bankruptcy Code of 2016, and at least in my assessment, the central bank's efforts to clean up the banking sector, using it as the backbone of India's way to resolve the non-performing assets problem was very crucial. 2 things I want to add here, though, maybe slight color on it. One is that the primary effect of Insolvency and Bankruptcy Code, besides the resolution of the existing bad loan cases, has been one of deterrence. I think for the small businessmen, and what I mean by small is not sort of really small and micro businessmen, but I would say not the very largest industrialists and corporations of India, but sort of like medium to like publicly listed but medium-sized companies. I think there's a bit of deterrence there that if they get into the bankruptcy code, they'll lose control. And I think that has got them to manage their debts far more prudently. The second thing I would add here, and in my view, this is one reason why perhaps 6% inflation might have been desirable in some ways, is really that the full 3 years plus of 6% has helped deflate India's corporate debt. So suddenly India's corporate sector doesn't look very leveraged because actually the debt has been deflated away in a very, very powerful way, maybe beyond the expectations that they had because the inflation has been allowed to run higher than where it was. And I think that has helped. It means that actually an investment cycle can take hold. They are not constrained by overhang of huge quantities of debt. And I think these are all very positives. But to me, the biggest positive for medium to long run growth in India is really what's happening in the tech sector and the entrepreneurship that is underway there. If I can take maybe a couple of minutes, Arvind, to give my view on this. I think to me, this is the story of India of the last 10 years. I think we've seen many other changes take place in India that we talk about a lot. But I think the plumbing of tech and digital India that's been created over the last 10 years on the back of the Aadhaar, the UID, the payment system that's been created, and now all the modular development that is taking place in the sharing industry, for example, the e-commerce and the sharing industry. I think this is just tremendous. India has taken a very different path on this than the United States, where the entire plumbing develops in a private manner. It has taken a very different direction from China, where the plumbing was all sort of heavily developed by one big financial firm, and then the state got a bit of a cold feet about the growth of that private firm. India, in contrast, has developed the India stack, or the plumbing of digital India, in sort of like a public utility kind of view of this. This is a public good. Let's provide UID and its authentication. Let's provide the payment system. Let's provide all the software that one needs to build a company on top of this as standard software that's called India Stack. Sort of the technical term is APIs, a common set of APIs that a fintech company can just go there, use these APIs, figure out their idea, build a software on top of it, and that sort of reduces the barriers to entry very tremendously. I think to me this is just fascinating. If you go to India, you go to an engineer who's just graduating, the level of entrepreneurial spirit they have is so high, it's because they see the barriers to entry in the tech sector as being very, very low. And I think this has created a tremendous shift in the tech entrepreneurship we had. So in 90s, we had the first round of tech entrepreneurship where, the likes of Narayan Murthy and so on, they were developing software for the firms in other parts of the world. In fact, they were not even developing software. They were just implementing, customizing, and maintaining softwares like SAP for the rest of the world. They said, we'll do this in huge quantity. We'll do it for the rest of the world. We have engineers who can do it. Then these engineers got confident and they said, why don't we develop softwares and products for these companies ourselves? That was, in my view, the second generation of the tech entrepreneurs in India. Every one of us has friends who did this. Partly some software developers are back in India, some of them are in Princeton, some of them are in Texas, wherever, and they are now sort of serving the rest of the world. But the new wave of entrepreneurs I'm seeing in India in the last 3-5 years is they are saying, no, I want to develop products for the Indian consumer. They are now developing products on top of this India stack, because until now, India didn't have the payment systems until the last 7-8 years. It didn't have this common set of apps through which you could penetrate. You couldn't actually ensure fraud is not taking place because UID and its authentication were not there. But now all of this plumbing has been provided publicly to all these bright minds who can just with very low barriers to entry jump in. I'm sort of making it a bit facetious when I say low barriers to entry. Of course, they need finance, but this is where I think the whole FDI wave of venture capitalists, private equity, the fact that Indian equity markets actually trade quite well, there's an exit path that is visible out there. There's a deep financialization taking place of Indian savings. So a lot of Indian savers are now putting money into the stock market rather than putting it just in gold and housing. And to me, the sum total of all this, they're all feeding on each other. But to me, this is the medium-term growth potential of India. I think this is where I see 7 and 8%. In fact, on the brick and mortar industries, I have some concerns, but maybe I can come back to it later.
Perfect. So on digital also, let me come back on a little bit more details. Poonam, on the question of medium to long-term growth.
So India certainly has the potential to grow at 8 or higher % in the medium to long term, and the number of reasons for it. Some of these were mentioned by Viral. Others were mentioned this morning. India's favorable demography. There has to be some democratic dividend, hopefully. A large and diversified base, entrepreneurship. And the fact that many, so it's also by the process of elimination. So if you look around the world and you see why growth is not happening in specific countries, and there can be any number of reasons. One of them is the country may be too dependent on one or two commodities, such as Chile, and a terms of trade shock happens and the country cannot grow. So to that extent, India's large and diversified base really helps. And that's one of the reasons why India has grown consistently at 7% average in the last decade at least. And the same factors will remain relevant and can make India grow faster at 8%. But if I look at the next year or two, 7% certainly, but I'm also seeing some headwinds. One is that fiscally, it will not be possible to support growth the way it has been in the last couple of years, given India's public debt and deficit numbers. Viral mentioned monetary policy with inflation running at more than 6%. Monetary policy support is unlikely to be there to growth as well. And I think that 7 to 8% or 8% and more in a very accounting sense will require more success in exports. We talked about the initiatives that have been taken by the government on export side, PLI being one of them, and private investment. So for all the talk that we are hearing about investments increasing, private investment to GDP ratio remains low compared to the peak levels that we have attained earlier. So I think once these issues are figured out, there is no reason why India cannot grow at 8 or higher percent rate.
Thanks. Okay, so I'll add to that fact, that at least if you look at the investment to GDP ratio, that has been climbing up. Last 3 quarters, it has steadily climbed up. And the latest quarter for which we have the data, it's about 34.5%, which we have not seen for quite a few years. So if that trend sort of, either holds up or even continues, that's going to be fantastic. So I mean, to me, that appears to be a very important sign, because also, I take your point, Poonam, that fiscal support as well as monetary support perhaps will be less than what it has been in the last 2 years. But at the same time, private investment, if this figure remains at 34.5% or more, clearly it's a private investment which has to have been responding. So, and that certainly goes well with the fact we have discussed, which is the straightening of the balance sheets of the corporations. So, okay, now on this, where do either of you see, let's take it with you, Poonam, first, the China plus one phenomenon that is going on. So far, this diversification that the multinationals are seeking, even if they don't want to come out of China completely, certainly there is a big push to have at least one other location of production. But much of that movement so far seems to have really concentrated in Vietnam, in something like apparel, etc. Perhaps, there's been some movement into Bangladesh and all. Some movement, now one sees a little bit of this activity happening, coming to India. But still, so far, in terms of the level, how much it has come to India, still India is kind of falling a little behind. And I would sort of argue that, look, without some of these very large multinationals, particularly in manufacturing, coming to Indian shores, simply because it is these large multinationals that tend to be well plugged into the global marketplace, which is what India really badly needs. Without them actually coming in, it is hard to see how we will actually, get manufacturing grow a lot faster. And at least the past experience need not be necessarily the prediction of the future, but certainly in the past experience, it is hard. There is no country actually which grows on a sustained basis beyond 8%. Without manufacturing really growing at least double-digit rates. So that's kind of roughly the context of my question.
Yeah. So I think I agree with whatever you just stated, 100%, in a couple of different ways. First, for India to grow at 8% and above, manufacturing will have to contribute to that growth rate. So based on the strength of agriculture and services, and manufacturing growing at an average rate of both. So India's agriculture actually has done quite well in the last decade, growing at 3.5%, 4%. Services has always been doing well the entire last 3 decades post-liberalization, being the fastest growing sector. The reason why India has not been able to sustainably break into the 8% plus mode is that manufacturing has not done as well as we have expected it to. And there's something about India not able to get the scale part of manufacturing right. And that's the reason why we have done relatively better in capital and skill-intensive manufacturing, which is not overly dependent on scale, but not on unskilled manufacturing, unskilled intensive manufacturing. So, in my current job, I do get to talk to the private sector a lot more than I could earlier. Actually, our governing body consists of some of the best names in the private sector, and they are really very exuberant. So if we look at the bullishness of this conference on a spectrum, They are really to the far right. And for them, sky is the limit for India. But when you look at the numbers and what is getting displaced from China and coming to India, that has not yet started to happen at a meaningful level. In fact, in parallel through the day, I was completing a PPT to make to the Prime Minister next week. And there I'm showing Vietnam in comparison to China, both its resilience to export merchandise, whether the global economy is slowing or not, Vietnam continues to gain in share. So 10 years ago, Vietnam actually exported only 0.6% of the global merchandise trade. In 10 years, it is at India's level 1.6%, so has gained 2.5 times the market share. India has remained at 1.6%. So that shift has not yet started to happen, but I also agree with you that that shift would be really very important for India to realize its potential of 8% and higher. Now, what will it take? I really don't have a good answer because as a student of the Indian economy for nearly 3 decades now, we kept talking about all kinds of challenges. This morning we talked about small-scale reservation, labor market, land market, finance. A lot of those things we have fixed, maybe not fully, but at least partially, and at least we have shown the intention to be fixing all those things. Now we have an industrial policy as well. I think it remains to be seen whether we can convince the global investors to come and produce at scale in India, and hopefully that will happen. And after this session is, of course, Mr. Amitabh Kant, who will tell us why it's possible and it's going to happen. I haven't seen it in the data as yet.
So, in the interest of time, since I want to cover 2 more subjects, let me move on to something else, which is your forte, the financial sector. So now, in a way, ultimately, it is the credit which is the lifeblood of an economy, and really without credit, there's no game. A lot of fixing has happened in the financial sector, no doubt. If you look at where the banking and other financial institutions were, let's say 25 years ago, there's a complete transformation. And yet, a lot remains to be done. What are the kinds of things, including, if you will, bank privatization, but I suppose there's a lot more than just that, or some sort of reform of the public sector banks. Whatever you think, what do we need to do in this sector now in the next, let's say, 3 to 4 years?
Yes, so I think in some ways we are in a sweet spot right now because we've just gone through a debt cleanup of the corporate sector. We've gone through a rebuilding of the capital base of the financial sector. So in some ways everything looks fine right now. And of course that could end up being a bit misleading because it might seem that the reforms are not needed. I would support actually privatization of at least some of the state-owned banks, maybe starting with perhaps some strategic stakes of significance being sold by the government to a significant institution, have them do a makeover of the human capital, risk management, technology of the bank, and then gradually complete the privatization. I think there will be gains from it. There will be a distance from the government and the ministries from the operations of these banks. And whether we like it or not, ultimately, when things get a bit difficult, public sector banks are used to allocate credit in India. I think it's there. That push is always there. The mission creep happens as you get close to an important election of some sort. So I think it's good to just wean away from this. To me, it was a historical mistake that we seem to keep justifying and perpetrating in a very large scale. And I think the current valuations of these banks the public sector banks might be a golden opportunity, in my view, to complete the process because the government can actually do it at a good price. There's a second point I want to raise, though, which is a bit of a point of concern for me, and I don't know what exactly is the way to deal with it. Is that, as I was saying, the IBC and the deterrence effect from it is working very well in keeping things in check for, I would say, relatively medium-sized publicly listed company. But I think if you look at our very largest firms, 10 to 12 of the largest firms, they are actually growing debt at a phenomenal pace. In fact, there was a Financial Times list called the Debt Monsters, and 3 of our firms were actually listed in there. I don't want to take names of any individual companies here. My concern is that as we are shifting into the China plus one economy on the manufacturing side, many of the foreign companies that are coming in are actually doing partnerships with some of these largest industrial houses who are very heavily indebted. And you have to, their debt is very complex because they're very complex organizational structures. They have like zillions of companies. There are interrelated party transactions that go on in these companies. So even understanding their debt is very, very complex. Why is this a point of concern for me? Because if something goes wrong, and it will, we can't just take things for granted. 8% is our aspiration. There will be some shocks around it. I'm not sure IBC can handle these large giants very, very well. The pressure on IBC, the pressure on the central bank when we were trying to clean up the debt was all about some of these largest companies and dealing with them in IBC. So I think a way needs to be found to keep the largest industrial houses of India, in my view, from not growing just on the back of debt capital, because I think it could become a sticky point if there are growth uncertainties that materialize. And as we've been discussing, they can come from outside India and not necessarily from inside India. So I think this is a very big question. RBI has tried in the past reducing the debt concentration that each bank has on a particular industrial firm. SEBI and RBI together had also done something to ensure that bank debt was actually limited. But for the life of me, I've not been able to figure out whether for the largest industrial houses, because their capital structures, because their organizational structures, subsidiary structures are so complicated, whether they are actually bound by these rules or not. And I think that that opacity is a source of concern for me. I'll stop there.
Interesting. Poonam?
So let me talk a little bit about the entire financial sector, not just the banks. On banks, I think the views of all 3 of us align that public sector banks have been totally underperforming. Some statistics which I pulled out of a paper that Professor Panagariya and I had done a few months ago looks at the incremental deposit collection and credit allocation by public and private sector banks. Now, despite the fact that private sector banks are about 30% of the total banking assets, in the last 5 years, they are the ones who have managed to attract half of all the new deposits that were deposited into the banks and made 70% of all the private sector credit. So there's clearly a big difference in the way public and private sector banks have been performing. And in fact, as soon as the technical capabilities of the government can handle, these banks should be privatized. I will not even wait for the market valuation to be one way or the other because it's so small that it does not matter. You cannot look for the right time. So as soon as there is political appetite, as well as technical capacity, these should be privatized. But I think where the 2 other areas of concern really, one is that even if the banks are performing really well, what kind of household savings are they attracting? So in the last few years, India's household financial savings, the savings that get channelized to different financial markets and instruments have stagnated. As a percentage of GDP, which means that for India's growth ambitions to materialize, it will have to attract external savings. And that needs to be done in a very prudent manner. You don't want to attract short-term fickle capital, the kind that's reversing from the country currently. You need to be able to attract long-term capital. And that is where India has not done particularly well, which is attracting foreign capital for long-term finance or for infrastructure finance. And I think that's something we need to figure out how to do well. There's one more segment which has come up and has grown well, which is the NBFC sector, which is great when it comes to financing small loans, household credit, etc. But it's not a substitute for the long-term financial markets. I'll stop here.
Thank you, Poonam. So my last question relates to the real kind of elephant in the room for India, and that is on the jobs challenge. And to put this in perspective, today, about 45% of India's workforce is in agriculture. This is from the latest PLFS, the Periodic Labor Force Survey. The share in the GDP of agriculture is about 15%. Put those numbers together, what it basically tells you is that average labor productivity in agriculture is about 1/4 or 1/5 that of industry and services combined. So there is a large gap, and if you just project this, what to expect in the future based on what we have seen in the recent past, the output share will continue to decline simply because agriculture really cannot grow more than 3%. The best we have done in the 1980s was 4%. But if you take the full, 50, 60-year average, it's about 3%. So the best I think agriculture is going to do, even if you take the optimistic view of 4%, industry and services will certainly grow at twice that rate, at least. Even for 7% aggregate growth rate, industry and services will have to grow at 8%. So what that tells you is that if this process continues, this kind of chasm that exists between the labor productivity in agriculture and on the one hand, industry and services on the other, is going to grow even deeper. What that's telling you is that simply that the movement of the workforce out of agriculture into industry and services that needs to happen, which is really part of every major economic transformation, whether you look at South Korea, you look at Taiwan, you look at China, etc., is not happening in India as rapidly as it needs to happen. Nothing close to what these other countries did. So that it really boils down to creating good jobs. Incidentally, on that, there is this fiction that goes around in the Indian press that unemployment is a huge problem in India. It's not. Repeatedly, even in the 2020-21, actually, the unemployment rate fell and it was at 4.2%. Given the levels of income, everybody has to do something to, get their 2 meals a day. So it's not that people are not working, they're working. The real problem is the underemployment or low productivity employment. It is the good jobs. Now, on the one hand, Viral, you built the case about the digital economy producing these fantastic entrepreneurs and so on, and I believe that story. But that also doesn't solve the jobs problem, because at the end of the day, the population or the workforce that I need to create jobs for is currently in agriculture. I can't turn them into tech entrepreneurs tomorrow, certainly not. And even the employment intensity of these, tech enterprises is relatively low. Largely good jobs are the skilled labor jobs, which is not what this is going to do. So I think this is really the central problem to me of economic transformation of India, which it has to accomplish in the next 10 to 15 years. Without it, I think there is really no game. It gets into the issue of poverty as well, but by and large, this is the large population that needs to be brought up. Now, I also, by the way, point out one more statistic here, that so 45% is in agriculture, and of the remaining 55%, only 10% of the workforce currently is in enterprises which have 20 workers or more. So, and 20 workers or more 20 workers is not a large enterprise. But let's say, we count that as large. So it's only 10% of the workforce that is in these enterprises with 20 or more workers. The rest 45% is actually sitting in these enterprises which are less than 20 workers. And vast majority of it is in operations which are family-run operations with no formal workers actually employed. These are called the own account enterprises in the Indian terminology. So clearly this is the big challenge that, how do you create good jobs for such a large population? At least, in 10 years' time, we got to move about 100 million workers out of agriculture into industry and services. So.
Yeah, it's of course a very, very big question. I have three ideas. Maybe I'll start with the least controversial and then proceed to the most controversial. First, I would say what we seem to be doing really, really well is tech services. I think it's fair to say we are the tech service giant of the world by sort of any comparison to anyone. So I think at a minimum, what we are doing well, we should continue doing well. We should expand on that. We should find how we can actually not have a wage inflation of 10, 20, 30% sometimes in the tech sector, because we actually need to expand this sector. The fact that software engineers' inflation of wages is in the 10 to 30% range is a sense that we don't have enough skilled labor here relative to what the rest of the world is actually demanding, given the quality of our tech export companies. Second, I would say in manufacturing, we have to produce for the rest of the world. I just don't see how we can create jobs there unless we produce for the rest of the world. And I would say here, the model we can learn from is our tech services model. How did our tech engineers become so good? It wasn't because they were at IIT. No. I'm telling you, I wasn't that good when I was at IIT. They became good because they went and figured out how we can be the best in the world. The tech entrepreneur in India today is really the best engineer in the world because he or she has actually gone and competed with the best businesses of the world and yet provided the service at a cheaper cost than what anyone else can. I think in business, in the brick and mortar industries, in the manufacturing, I think we have a fundamental problem. Our tariffs are just too high. In my view, this is a way of protecting the domestic industrialists, the domestic big guys. They are not allowing competition from foreign capital to come in. They're becoming bigger and bigger, as I described, for my comfort, becoming bigger and bigger on the back of debt capital, which worries me even more. But I think even though our tariffs are lower than our historical peaks, they are just way too high. We have got to have the biggest industrialists of our country producing for our economy while they are competing with other folks who are allowed to come in from the rest of the world at reasonably low tariffs. They'll just be sending their goods over. So to me, this is a very big challenge. It will be fought tooth and nail by the incumbents. They don't want the tariffs to go away. But I don't see any substitution. I'm not convinced that if we keep tariffs high and we create local oligopolies, we create giants. I'm Gujarati, so I can crack a joke on my fellow Gujarati businessmen. I don't want to wake up in India having brush from toothbrush and everything from Gautam Bhai and a phone from Mukesh Bhai. No, I want to do things which are coming from other entrepreneurs. I don't want two names to be ruling my entire life from morning to night because it can't be good for the rest of the country. It means barriers to entry must be very high in those businesses. How can they become so large otherwise? I have no other way to explain it. I think the tariffs have got to come down in my view, because until the tariffs come down, until they produce what foreigners produce, and at the same level they produce for the Indian consumer, I don't see how they can export. no one is going to take their products if they are going to compete in the global landscape. And until they are producing in big quantities for the rest of the world, I don't see how we can create an employment machine that's going to create huge jobs for Indians to come out of farming. Last thing, the most controversial, it would be that I think farming in India is too subsidized. It is subsidized on credit, it is subsidized on water, it is subsidized on electricity. And until these factors of production continue being supplied to farming at below market costs, it will remain attractive to keep going into farming. Because, how do you get them to get that business to compete with another business on a level playing footing? So I think this will be the most, even more hard-fought politically. But I think we have to find a way to wean the system of these subsidies, because I fully agree with Arvind that with the level of potential our human capital has, it kind of seems a contradiction that we have such a huge proportion of jobs in farming still. Something must be directing them to that sector, and I think it's the low costs of factors of production they enjoy.
Thank you. On your Gautam and Mukesh Bhai, the Ratan and Chandra Bhai will be very upset with you.
Yeah. No, as I said, I can only crack jokes on my Guju Bhai, though Ratan Bhai might say he's also Guju.
So, Poonam.
So I agree with you completely. Jobs, good jobs is a big challenge. Do we know the answer? Not necessarily. As a policymaker, I guess you can perhaps try to engineer growth and hope that job would be an outcome of that. Just a couple of points to add to what you and Viral said. The jobs challenge that we are seeing actually can be much bigger if women think of participating in the labor force. So the job challenge that we have is when women are staying away from the labor force. In fact, it's a much bigger challenge. What can be done in the short run? Not much, unfortunately, except that as Secretary Subramaniam said this morning, and this I've said in my limited interaction with the top policymakers, when we think about exporting goods and services, we should think about exporting goods, services, and labor. And it's really welcome that export of labor is a part of the FTAs that we are discussing. There's just so many people out there that we cannot absorb them domestically in the next decade, even if we turn around our manufacturing and if we do better on services. So export of labor, certainly. Enhancing the skill set at all levels is absolutely essential because the skill intensity of most activities is increasing. I generally do not like a sectoral approach to think about job creation and growth, but given the magnitude of the problem, perhaps it's also time to think about doing better on some of the skill-intensive activities outside of manufacturing, such as becoming an education and health hub of the world, if not of many other countries, which are comfortable coming to India for these services, and tourism as an employment-generating activity. India has done reasonably well in education and health, so it's a credible producer and exporter of these activities. Tourism is underexploited. And sitting through some of the meetings, actually in the PMO, I realized that sectoral approach is something that policymakers think about. And I had to change my way of thinking about things, that you make the environment growth conducive and let the private sector come in. It's too broad brush for them. So you have to tell them which sectors. And these sectors certainly have the potential to do much more and generate both growth and employment.
Thank you. Okay, so, now our rock star is here too, so I don't want to stand between him and the audience. We are also running a bit late, so maybe we do one or two rounds, maybe one round of questions, and then we'll bring this to a close. Okay, so I see 1, 2, 3, my goodness, 4, 5, you too, 6, 7, Okay, I think this looks a little bit of a challenge. All right, let's start here and ask your questions crisply. No commentary.
My question is to Professor Viral. So on your point about India being providing heavy subsidy to agriculture, I'm just looking at the potential policy impact of it. So if we were to withdraw a lot of subsidy that we provide, there's likely to be a spillover of those who engage in agriculture into the labor market. So there'll be an addition of significant number of individuals into the labor market. Can we afford that new entry because we're not able to sort of effectively manage the current number of individuals in the labor market and provide adequate employment? So what do you think of it, and what do you think of the impact of your suggestion?
Okay, so that's one. Okay.
Professor, I just be very quick. So the corporate bond market in India is not so effective, and what do you think are the measures India should take, and do you prefer RBI investing in it like how Fed does it here? Thank you.
Okay, that's two. Okay, here. I'm trying to get our students first.
My question is very simple. We talk about jobs, we talk about skills, and we don't have a clear solution, but is there a problem in education? Are we investing for some reason in education, and why, like, we still have most of our country not going into higher education? So.
Okay. Yeah, back there, yeah.
Hi, my question is for Dr. Acharya. He talked about how India is the technology giant and service provider for the world, but we don't have any Web3 sectors. We don't have research going on in cybersecurity.
Sorry, what was it? What do we not have, you said?
I'm talking about the Web3 development, Web3 blockchain, metaverse. There is no communication talks about that. So how are we still not living in like denial of the fact that we are technology giants? Are we still just not? I mean, I understand Y2K, but that was long back. So the stride has already changed in the world of technology. Is India even providing those services? Similarly for semiconductor, what is the country doing?
Okay, you already have the microphone. Go ahead,
Yeah.
go ahead.
First of all, thank you, Poonam, for being here. It's really good to see an Indian woman right there, I mean, after a long day. So my question is regarding the informal sector. Where do we see the future of informal economy of India? Because more than 80% of the non-agricultural labor is in the informal sector, and we saw them being really hit during demonetization and also after the pandemic. So I would like to hear your views on it. Thank you.
Okay, and we have that hand in the back for a while.
Quick question on MSME access to capital for the non-services companies. If you were trying to grow the market and the jobs, outside of agriculture, how do entrepreneurs get access to that capital? And I just want to say that the morning session, in contrast with $30 trillion is projected for in India at 100. What do you guys think about that? Is that, because what I just heard is very sobering. So if I want to get your reaction to the $30 trillion target in India at 100.
One. Yeah, we still have two more hands. Okay, let's take care of the last two, and that's that.
So my question is about the laws around bankruptcy and securitization of and enforcement of assets in India. Manufacturing has been very low, and it hasn't increased in a while. That's what we've discussed. But do you think that the laws and the policy have gone wrong at some point because small-sized industries have been reeling in the effects of these laws and slow judicial disposition of cases? And what kind of impact do you think this has on the economy?
Okay, and there's the last one.
Good afternoon. Ms. Poonam Gupta, you mentioned the various high-frequency indicators that you look at. You talked of one. Could you enumerate some of the other high-frequency indicators that you look at? And to Dr. Acharya, we have such a clear idea about what we have to do to develop our manufacturing sector, and that would lead to a stronger job market and so on. Is it labor market rigidity that is keeping us from making moving our people from farming to manufacturing and so on? Are we not teaching the right vocations? Is it those inefficiencies, or is it political stagnancy or something like that? Thank you very much.
So, 5 minutes and 5 minutes, then we wrap up.
I fully agree that you can't just sort of make it hard for agriculture without creating jobs in parallel. So the things I mentioned have to be done either in the right sequence or at least at a minimum together. I fully agree. We have to have jobs available for them to work in capital-intensive, labor-intensive industries in one form or the other. So that they have to go hand in hand with, I think, becoming de-tariffing in a very significant way and somehow getting a bigger share of the world manufacturing trade. In my opinion, there cannot be a corporate bond market in India that thrives until the fiscal deficit and the government debt to GDP remain so high. Everything in the machinery is geared to keep government borrowing cost of capital low. And the central bank's many rule-making is constantly juggling how to get markets to develop, but not have the government cost of borrowing capital rise too high at the same time. I think somehow we need to find a way to reduce fiscal deficit and debt to GDP so that some of the savings can actually go into the corporate bond market. Our large institutions like pension and insurance company allocations are so heavily in favor of government bonds that corporate bond markets can't really thrive in a setting of that sort. I fully agree. We need more investments in education. We don't seem to do as much. That would be one way to generate more skilled labor and reduce the wage inflation in the tech sector, for example. Of course, many things are related. How do you get people to pursue higher education? Maybe then farming doesn't have to look so attractive, or they have to be tapped into quickly enough or early enough in their life so that they don't think that is the way to go. On MSME, I want to make 2 points. I think whatever is happening on the fintech space, the digital plumbing, I think it has tremendous capital to actually make MSME financing much cheaper than what it has been. Indian banking and even non-bank so far, they've done very physical collateral-based lending. But a lot of MSMEs in India have no physical capital. They are basically service providers in one way or the other. So for a service providing MSME, the collateral you need is information. What is the pattern of their cash flows? What is their liquidity risk? How much comes in which quarter? What kind of shocks are they subject to? If we can encapsulate all this data through, say, GST platform, utility bill payments, other kinds of contracts that they might be doing, then you get a cash flow collateral, a pattern of cash flow collateral. Then you can have credit scoring algorithms going on top of it. So I think this is a very exciting space, and MSME cost of capital, in my view, should come down if things are allowed to go in the right direction. I agree that small businesses have had it very hard because of repeat shocks. Part of the problem is that the central bank has also then had to provide a very large amount of forbearance on these assets. So the cleanup that has happened of corporate India, the large corporate India, it actually hasn't happened in the MSME space. I'm not recommending that it is easy to do or we should do it right away, but that sector is still reeling, in my opinion, under a debt overhang problem that we've managed to deal with for the large corporate India. The last question was that our companies are not into blockchain, metaverse, chip design, etc. I think they will be. I'm confident that Indian software companies will very soon be a part of this. Whether that happens on Indian shores or whether it happens outside, I think that remains to be seen. And I think there was one more question on what prevents. If everything is so obvious, what prevents it from happening? See, in policy making, by and large, it's very easy to do incremental things. You like to take the system as given and then, do a little bit next day, a little bit next quarter. Some of these things are a little bit more, I think, I would say, shaking up the system type reforms. With political stability of the kind we have right now in India, I think it may be possible to do these kinds of reforms. I'll leave it on that optimistic note.
Thank you. Poonam?
I'll just take some of the easier ones. High frequency indicators, so I can give a few at the top of my head. Mobility, both air transport, rail transport, and freight is growing at double digit. Credit growth growing at double digit. Tax revenue collection has been growing very, very well. Tractor sales, automobile sales, perception-based indicators, PMIs, etc. So when in preparation for today as well as for this presentation that I have to make next week, I looked at all the indicators and I had two categories. Indicators which are doing well, indicators which are not doing so well. Everything fell into the indicators which are doing well except for exports growth, which have slowed down last 3 months, and capital flow reversals, which is both of them are due to the external reasons. On 30 trillion economy, it's the power of compounding. You grow at 7% a year consistent, you can become 30 trillion in about 30 years. So if you want to become 30 trillion in 25 years, I think the assumption is 7.5%. Secretary Subramanian gave this number, so I was calculating. So if you grow at 7.5%, you'll become 30 trillion, and you can do the math yourself. On informal sector, given that there's no data, I find that it's, the narrative usually is very emotional, right? It's a sector which needs to be supported. I don't know how well or badly this sector is doing because of the lack of data. But just staying in Delhi, I see a lot of innovation happening in the informal economy as well, which is actually partly due to the digital connectivity, both the payment system and the ability to now deliver, taking orders online and being able to deliver. So there is a lot of innovation happening in that sector. How well is the sector doing overall? I mean, due to the lack of data, I cannot say anything about that. Thanks.
Okay, well, thank you both. I hope you all agree that we had a great session.